Hey everyone, welcome back to another episode of AWM Insights. It's your host, Justin Dyer, Chief Investment Officer here at AWM, joined as always by my co-host, Mena Hanna. And Mena, today we're going to talk about AI, straight up. But, as I always like to do, I like to expand and talk about nuance. AI is a massive topic, right? It's very popular and prevalent in the public markets. It's very popular and prevalent in the private markets, or specifically within the world of venture capital, and it's impacting those markets in positive ways, negative ways. I mean, you take your pick, and you can probably find an argument on either side. But today we're going to try to help listeners understand our perspective and digest what's happening more so on the public market side of things, and the impact, good, bad, indifferent, on what's happening. And kind of more specifically, hey, is this something we should be taking action on? Or how should one digest, react, make any movements with respect to AI specifically in the markets today? So as always, kind of setting that table, setting the stage, what is going on? What are the big headlines? Again, we could probably talk for an hour about what's going on in with respect to AI, but high level, top line, what's going on in public markets specifically with respect to AI?
Yeah, tons of headlines. They kind of sit in two buckets. The first bucket is a lot of these large businesses are laying off employees. Shareholders actually like that because it makes these businesses more profitable, cuts out costs, but sometimes it impacts long-term results. We'll see. These companies are kind of making bets that they could do more with less, and we'll see if they can execute on that. Obviously not great for the labor market, but sometimes actually good for companies. The other side of that is companies that are focused on software as a service. SaaS, you can think about companies like Zoom, ServiceNow, Netflix is sort of in that camp, but they have licensing, Adobe. Those companies, these software-focused companies, have really taken a bath because AI is presenting a problem for them from the standpoint of, why would I buy Adobe when I can Claude vibe code a similar software that's for free, that I can use forever without having a license and without, giving anyone else money, and just using tokens to create it. So it's sort of shifting what software is going to look like. And yeah, that index is down 30% in the last 6 months, which is intense. Yeah, it's super intense. So yeah, that's what's going on.
Yeah, and that's the big headline. The quick interpretation of it, at least from our perspective, is, hey, markets are efficient. And so they're taking this information, digesting it, and reflecting it in prices. Now, here's the wrinkle, and I think the piece of this perspective or belief that often gets overlooked. We're not saying that is 100% correct. We're just saying outguessing the markets on that is incredibly difficult to do. It's a losing proposition if you go back and think about outguessing markets on a kind of a number of questions, right? Trying to time it, trying to predict the future, et cetera, et cetera. Like, all those things are within this kind of market efficiency type conversation. But let's take that a step further. I mean, let's pull some data to support that. Does it make sense given all the money that is chasing AI, the concentration that AI companies or the Mag 7 make up within the index? Both what does history tell us on the run up? Has this happened before? And then even on the backside of some of these things, which I'm kind of giving the answer to, like, what does that do? And what does that most importantly do to the idea of the 100-year family and supporting priorities for our clients?
Yeah, and if you kind of go on Reddit, I think the take is going to be, buy the dip, bro. Just do it. Close your eyes, buy the dip, and move forward. That works until it really, really doesn't. Railroads, when we were preparing for this call, we were kind of talking about railroads. Railroad stocks occupied 60% of the U.S. stock market in the late 1800s. I know that's a long time ago, but that's 60%.
It's a ton.
It's a ton. It was like our economy. Today, it's under 0.5%. So that is just a shift. And there's a company that has $100 billion market cap. So there are still large companies. The business of railroads didn't die. We still see trains.
Good old Warren Buffett loves them still.
Yeah, Warren Buffett loves them, but the economy changed. There are new technologies, that are new sources of travel, of transportation. So the economy grew, it matured, it developed. Railroads didn't really go anywhere, but the rest of the market's growth far outpaced railroads. So if you consistently bought the dip in the 1800s, early 1900s, you eroded your family's 100-year wealth, and you probably wouldn't be working with us today. So that's a good use case. Like, these things change. There's creative destruction that happens. And if you focus on the wrong asset class at the wrong time, you can get wiped out in certain situations.
And what you just said is a much more interesting, eloquent, maybe even entertaining version of diversification.
Yeah.
That is why diversification works. The term, maybe you think it's boring, you hear it all the time, all that good stuff. Diversification is actually incredibly powerful because it's the responsible, high probability way of capturing what markets are actually doing and what innovation is doing over the long term, what this creative destruction does, what companies competing with one another does, right? Diversification allows you to capture the power of all that without overly concentrating in one way, shape, or form, and really doing so in a way that you should have confidence in meeting what's most important to you. Kind of bringing that to a more tangible example, right? You talk about railroads. We don't just have to go back to the 1800s to have examples of this. Maybe that's a really good comparable for concentration in the market, but there's booms and busts. Sometimes they're concentrated in specific industries. .com is a version of that. Now, it was so small at the time, it was not as much of a concentration, but it was meaningful, where on the backside of the .com bubble, if you were overly concentrated in technology and then rode that out or bought that dip, you didn't recover fully for 15 years. From the peak of the .com bubble, this is using NASDAQ composite, peak of the .com bubble, it took the NASDAQ 15 years, 2015, that was 10 years ago, to fully recover. And so that's the flip side of this, right? Yes, you get these crazy run-ups. A lot of times they're associated with bubbles, but then on the backside, the true damaging part of overly concentrating in a bubble or a specific sector or just a specific company, right, or stock. You can say the same thing whether we're in crazy market environments like we are right now with respect to AI or bubbles, et cetera, is what happens when you get that wrong, right? You're effectively trying to say, I'm smarter than the market. I can outguess the wisdom of the crowds. And the data shows that can happen, but it's a very low probability event. And then the damage that can be done if and when you get that wrong is incredibly substantial and puts that 100-year family at risk, most importantly.
Totally. And I would reframe it, and I'll use another example, financial services. 2007, financial services represented 30% of the US stock market. Today, it's 12%. If you invested in financials in 2007, it took you 10 years to actually recover. Obviously, the Great Recession tanked a lot of those banking stocks, and a lot of those companies took you 10 years to recover. Today, it only represents 12.5% of the index. You're up, you're in the green, you made a return. That's the wrong way of looking at it, because you just went from 30% of the market to 12.5. Everyone else around you made way more money. So I know that's a little bit of keeping up with the Joneses mentality, but when you think about investing in the market and realizing a return, it's about keeping pace with everyone else around you, and ideally outperforming slightly by, doing all of the right things and being the casino. But if you make the wrong move, if you're overly concentrated, you are wiping off a serious amount of your return, and of your wealth, which in a situation like this, if you're overly concentrated, you're not making that back. Yeah, your position in the market is a third of what it was before. So
Yeah, that's right.
it's
I mean,
dangerous.
look, we're not going to say the same thing is going to happen today with AI. That we're not going to predict the future in that. But history is an incredible teacher. Success leaves clues. We have a sense that the markets behave very similarly over time. History doesn't repeat itself; it rhymes, is the great old quote or comment. And that's what we use to apply, or how we think about markets specifically, and investing for that 100-year family. What does the data say? What does the academic literature say? Does it make sense to try to time markets over the short term? No, that's a very low probability outcome. And so again, what's most important to us is that long-term 100-year family. We know the behavior that has led to success in the past and have high confidence that will lead to success in the future. And getting caught up in hype cycles and timing, et cetera, we know it is just not a great recipe for success, and likely one of those bad decisions that can be substantially costly to your 100-year family.
Yeah. And I know you made the comment that diversification is boring. We're nerds, so we like it, but maybe our listeners and viewers don't. The way to make it cool, in my opinion, is there is so much destruction going on right now, so much innovation going on. The way that you actually access this innovation is through diversification. There's a surface level way of looking at diversification, which is I'm going to hold every single sector in the market. And there's a more sophisticated way of looking at it, which is I'm going to invest in private markets holistically. I'm going to invest in venture capital. I am going to access these best, brightest founders, businesses in the early stages where many people can't, and it's an access game. But I'm going to participate in these businesses because I will hit on an Anthropic, I'll hit on an OpenAI, I'll have access to a SpaceX, and that is a way that you can sort of not only keep up with the market, but ideally outpace it and make up the dollars that potentially might be lost in the public markets from time to time when you get these shifts in technologies and when you realize that creative destruction. So it is also super important to think about how are you truly diversifying, accessing private markets. All of the companies that I just stated are still private. So if you're buying an index fund, you're not getting access to them. Now, it doesn't also make sense to access them in the right way. You have to be very thoughtful in how you invest in private markets, but not investing in private markets and avoiding those holistically, which we've seen time and time again, is not really the comprehensive way of being diversified.
Yeah, 100%. I mean, and to your point, or what you were alluding to, like that's a whole nother conversation around accessing private markets in the right way. Well, cool. So we'll wrap there. Kind of quick takeaways. Diversification really is the only way to navigate markets like this. Markets of concentration, markets that are more volatile. It's the way to support your 100-year family and really invest like a pro. The reminder is just avoid the short-term noise for long-term investing success, and we'll leave you with that. Definitely keep questions or topics you want us to discuss coming.
626-862-0355.
Definitely text that number, and we will get it on the agenda here and give you our take, our thoughts, how we could think about answering a question or just digesting a general topic that might be of interest to you. But until next time, own your wealth, make an impact, and always be a pro. Thanks for listening.